All right. So we're switching from service companies where we recorded the credit to service revenue, and now we're going to be a merchandising company. This kind of company buys and resells inventory. Okay? Now, even more complicated kind of accounting for a company is a manufacturing company. This company buys raw material and turns it into inventory. So this one you'll do in accounting 230. So we don't have to worry about that one, but we do want to talk a little bit about what happens if you buy and resell inventory. That's what you do. So think of this as a retail store or a wholesaler. Okay, a middle person. As a middle person there. All right. So I always like to use the example of a shoe store here. Okay, we don't use raw material and make the shoes. We're not Nike. This would be Nike. We're Foot Locker or somewhere where we buy the shoes from a different bunch of companies and we sell it. That's what we're doing today. So one thing that we're going to change is instead of having service revenue as our revenue account, since we're not service companies anymore, we're going to use the word sales as our revenue account. So that's one thing that we're changing. Okay, just terminology, call it sales instead of service revenue. That's one thing. The other thing that we're going to change, we are going to make our income statement a lot more detailed. We'll see there. But this is some language change. We're going to, from one company to another. This is on the income statement, obviously. Then on the balance sheet, one thing that's going to be new is we're going to have this asset called inventory. So there's a new asset that's going to show up on our balance sheet, okay? And anything can be inventory. What makes something inventory is if you hold it for resale. So in Walmart, everything on their shelves at Walmart is inventory, right? So that's kind of what you think of as inventory. But we always kind of use, we always think of supplies as copy paper in our copy thing. We use it in our copy machine and use it up and it's gone. But if we were a retail store that sold office supplies like Staples or something, that copy paper would be our inventory because we're holding it for resale. So it's really what this is. This could be cars. If we were a car dealer, it could be inventory. This could be land. If we had subdivision and we're selling lots in a subdivision, that would be our inventory because we're holding it for resale. So anything that's being held for resale is inventory. Where do we put this on our balance sheet? Well, remember, we're going to do a classified balance sheet. So we're going to start with current assets. And we want to do the order of liquidity, what's closest to cash. So cash is always closest to cash. And accounts receivable is second closest to cash because you have to just collect it. Here you have to sell the inventory, then you have to collect the receivable. So the first three current assets on your balance sheet for the final should be cash, accounts receivable, and inventory in that order. Okay? Then if you have anything like prepaid rent or supplies, they can go down here. I don't really care the order of those. But these three, I will take off if you don't have the first three current assets in those order, okay? So those are just a couple of small changes we're making here, all right? Now, how does this kind of company make money? How does Foot Locker make money? Selling stuff, selling inventory, right? So I'm making a shoe here. I'll make a Converse. I don't know. It looks more like a Munster shoe, but that's okay. All right. So let's say that we sell this shoe and we have this sales price as a tag on it for a sale price, and let's say we were to sell this name brand shoe, whatever it is, for $100. Okay? Now we had to buy, let's just call it Nike, we'll put a swish on it. We'll say we bought this from Nike, right? How much do you think we paid Nike? Less than 100. That's how this company makes money. They have to buy low and sell higher, right? They have to buy lower amount. So I'm just going to use $40. I'm going to say that we paid Nike $40. So Nike paid we paid 40. We sold it to some people, and they paid us 100. So that's how we make money. The difference between this and this is how we make money. Okay. So again, the lower this is and the higher this is, the better we are. But if we make it too high, people won't buy our shoes. So we can't make it. Depends on our customers how much we can charge there. Okay. But remember, every piece of inventory in our store that has two tags. One is the cost of the shoes and one is the sales price of the shoes. This is the one that customers see. We don't want them to see this one, because then they'll say, you only paid $40, I'm not paying you $100. You don't really want them to know this one. Do you have a question?
Well, I was wondering if, like, as you compared Nike to the manufacturing company, do they get part of, like, the sales price, or do they just get any of that?
No, how Nike makes money is they have this manufacturing process and they hope that they can make it for $22, and then they're going to sell it to the store for $40. And then this is their profit, is the difference here. So they're trying to produce it low and sell it higher, but again, then the difference is here, right? So why don't people just buy directly from Nike? Maybe sometimes they do. The fact that if they can buy it on the internet, maybe that's what will happen, right? They won't have to go to a shoe store. With the shoe store, they can try them on. And the other thing good about a shoe store is they buy from Nike, they buy from Reebok, they buy from New Balance, whatever, right? They buy from a lot of different things. So you have a good selection at the store. That's one of the benefits of the retail store. They buy inventory from a lot of places. So if you think of Walmart or you think of Macy's, they have a lot of suppliers, right? And you can go and buy all kinds of stuff. Not just Nike stuff, right? So that's part of the benefit of it. But yeah, there are two markups, right? But anyway, this is our cost, and then that's our thing. So the way this is going to look then, we'll see, there's going to be some stuff up here on our income statement, we'll see later, but the key calculation on this kind of company is net sales minus the cost of goods sold. This is a new expense that we haven't had before. So here's something new again. Net sales minus cost of goods sold, and we call this number gross profit. So for this company, that would be $100 minus $40, and we'd have $60 in gross profit. This is going to be the kind of the top of our income statement. We're going to have some stuff above there, but mostly this is at the top. So instead of having service revenue one number, we start on our income statement with this calculation. Right? We want to know, what did you sell it for? How much did it cost you? And this expense, this is exactly what it's called. It's the cost of the goods that we sold. That's exactly what it's called. Okay? We abbreviate that like this. We don't usually call it COGS. We still call it cost of goods sold. But that is a new, and it's an expense. Okay, it's an expense. It's the expense there. All right. I have this right. There we go. That'll be better. So that's cost of goods sold. And we want to see, sometimes we turn this into a percentage, gross profit rate, our gross profit, sometimes we put the word margin rate in there, gross profit margin rate, and that is equal to gross profit divided by net sales. So gross profit, we know, is net sales minus cost of goods sold divided by net sales. So in this case, it equals $60 divided by $100 is 60%. Okay, so our gross profit rate, gross profit margin rate, is 60%. Often, people who talk about business are very lazy, and they'll just call this the margin. They'll say, oh, their margins are growing, or their margins are getting squeezed, or what's going on with their margins. So a lot of the big tech companies are giving their earnings this week, and so when I drove in, listened to the radio, I have CNBC on my radio, I can't tell you how many times they use this word margin. They're all talking about their margins. Are their margins good? This kind of company has to maintain their margins. So this is how if their cost of goods sold starts going up, then they'll probably have to raise their sales prices. That's one reason we're having some inflation in our economy, because costs are going up. And so they have to raise their sales price. Maybe people won't buy their car or whatever, buy whatever they're selling. They might have to keep their prices lower. Now look what's happening to their gross profit. It's getting squeezed. Some people would say their margins are getting squeezed. That's tough. They can't pass on those increased costs to their customers. So if you're analyzing a retail company or a merchandising company like this, you're going to keep your eye on this gross profit rate over time, and if it's getting smaller, that's a really bad sign. You don't want that gross profit rate to be getting smaller. That's important. All right? So now what we have to do is we have to do some journal entries for buying and selling inventory. Okay? Well, how you do these journal entries depends on what kind of accounting system you have for inventory. There are different systems you could use. One is called, over here. One is called the periodic method. And one is called the perpetual method. Okay? The difference between these two is how often do we update our inventory records? This one we update well, I shouldn't tell you, man. One of them we update only at the end of the accounting period. Which one do you think that is? The periodic one has the word period in it. This one is updated only at the end of the accounting period. This one is updated at each sale. Perpetually, always updating it, okay? And those are the entries we're going to do are going to be under the perpetual method. We'll see in a minute. All right? So, you already know how to do a periodic method. We've already done that. You just didn't know it because we weren't calling it that. So, let's say that we bought $120 worth of supplies. And we'll say we did it on account. It doesn't really matter that part, but we bought some supplies, right? So what we were doing in chapter 2, we would just put them in the supply account. Then we'd post that in the supplies account of $120. Then at the end of the accounting period, when we were doing adjusting entries, we would say there are $80 of supplies left. Does that sound familiar? I hope. I did that on the exam, right? So how many of these supplies do we want to expense? We have 80 left. We're going to subtract, right? So we have 80 left, so that means we need to expense this amount. So we're going to move $40 to supplies expense. the amount we've used, right? So supplies, expense, and supplies would be our adjusting entry. So this is just a review of what we already know how to do, right? This is a periodic method. So that's what I mean by you already know how to do a periodic method. We just keep putting the supplies on into the account here. Put them in, put them in, put them in. Then what do? At the end of the accounting, people, we count how many are left, $80, and we subtract to get how many we used. Then we expense this, right? All right? So if we were on a periodic inventory system, we would buy some inventory, and every time we bought inventory, we would just put it in our inventory account. So then we would have this in our inventory account at the end of the period. So again, we only update it at the end of the period. Then we count at the end. There are $80 of inventory left. Okay, so, that means, what does it mean? We're going to credit inventory for the amount that we sold and is gone. And what are we going to debit? What do you think? Before we had supplies, right? We did supplies, expense, and supplies, right? What do you think we're going to do here for a debit? Nobody wants to guess. No. It was supplies, expense, and supplies, right? So I'm trying to get you to say inventory expense, but that will track. It's cost of goods sold. It's not inventory expense. So think of cost of goods sold like inventory expense. Like, right, we did supplies expense. We figured out how many supplies we used, and we took the supplies out and put them in a supply expense. We're doing the same thing here. But for some reason, to make it hard, we don't call this inventory expense. We call it cost of goods sold. But think of this expense as, oh, that's the part of the inventory that we took out because it's sold. That's what this is. Okay? So when you do a periodic method, you record cost of goods sold at end of period. But when you do a perpetual method, and this is what it's going to be on the test, you have to record cost of goods sold at each sale and return. Okay? What does that mean? 2 entries at each sale and return. So when you read the problem, and this is on the sales side only, okay? When you read the problem and it says do the entries for the sale of inventory under the perpetual method, this is what should pop into your head. 2 entries at each sale and return. If you can remember that you need 2 entries, this is pretty straightforward. What makes students mess up is they try to put all the information I give them into 1 entry, and it gets really ugly really fast. Okay, but if you can remember, you're doing 2 entries. One for the sale, and one to record cost of goods sold, right? So at each sale, we're going to do this at each sale. We're going to record the sale, and then, I already erased the sale, that's just going to be accounts receivable and sales, and then we're going to record this cost of goods sold at each sale, okay? And that's so perpetual inventory method, I need 2 entries at each sale and return. Not each purchase, just each sale, okay? So if you can remember that, then this is going to be pretty straightforward. All right, so we're going to do these entries. Remember I said this is one of the things on the test. You need to know the entries to buy and sell inventory, okay? Often the book does the sales first, but I'm going to do the purchase first. I think it makes sense more that you buy the inventory first and then you sell it. So we're going to buy the inventory first. Now, I always say, don't make this this harder than it is. It's not something totally new you've never seen before in your life. But that's easy for me to say. I know it's, might not see the same, but these aren't totally new inventory problems here. Okay, so entries to purchase inventory. So remember, we're buying these from Nike, right? We're buying these from our supplier, okay? Not the people who are going to wear the shoes. We're the shoe store. So we need to do entries to purchase inventory. So the problem on the test is going to be very similar to this problem down here at the bottom, where it says June 1st, June 3rd, and June 30th. It'll be almost exact same wording, right? Different numbers and companies and everything, but it'd be very similar to that. So on June 1st, we bought some inventory, okay? So we bought $10,000 in inventory on account. So what happens in chapter 2 if we bought some asset on account? What happened when we bought supplies on account? What would we do? Accounts payable. We would debit this asset and we would credit accounts payable. Well, that's exactly what we're doing here. We're buying an asset. It just happens to be inventory now. We're buying inventory on account. We're going to pay it later. That's all that's to say. So again, that's what I mean by don't make it something totally new. We're buying an asset on account. It just happens to be a new asset called inventory, but we're still buying it on account. No change there. Now, how did I know it was on account? It doesn't even say on account, because it has these terms there. It has terms 110 and 30, okay? These are on Nike's invoice. And the only reason they're on there is because this was on account. If it wasn't on account, they wouldn't have these terms. So on the test, don't come up and ask me, did we pay cash or is it on account? They don't have these terms. You don't really need to know what they mean, but just know that they mean it's on account. What these terms mean are, I like to call this deal or no deal. Deal or no deal. Nike has given us this deal. They're trying to get us to pay them fast. So their normal due date is 30 days. That's what this N30 means. It means the net amount of the invoice, whatever the total is due within 30 days. So we have to pay within 30 days, okay? But we could take this deal, and this basically says, if we pay within 10 days, we can deduct 1%, oops, not $1. You can deduct 1% off the price. We can take a discount. Okay? That's what this means. 1%, if we pay within 10 days, we have to pay the whole thing net in 30 days. So if it said 215, net 45, that would mean you have to pay your bill within, we have to pay Nike the money we owe them in 45 days. If we pay early, if we pay within 15 days, they'll give us a 2% discount off the price. Okay, that's what that means. We aren't taking any discounts in this class. All you need to know is this means on account. Okay, this means on account. So I think probably companies aren't offering these right now as much because cash is cheap. Interest rates are so low, they can just borrow money if they're short on cash. So they don't have to give that discount away as much. But when you see those, that's what that means. But it does mean it's on account, so that's the one thing there. Now, we bought an asset on account, nothing new. But here's something new that we didn't really do before. And this was on June 1st. On June 3rd, we got this inventory from Nike and we realized, wait a minute, these shoes are some quality wrong with them. The sizes aren't what we ordered. Something's not right. So we're shipping some inventory back to Nike, okay? So here we're buying the inventory from Nike. Here we're gonna send some back because we don't like it, okay? And it says that we returned $2,000 of the amount. So we're gonna return $2,000 here. That's the number. inventory gonna be debited or credited here? We're sending it back to Nike. Credited, you're sending it away. The inventory's going away. So we're gonna credit inventory. Now, what's this debit gonna be? Do we still owe Nike $10,000? We're gonna debit accounts payable because we don't owe them this $10,000 anymore. We sent this $2,000 of inventory back. This is gonna reduce how much we owe them, right? I think everybody smart here can do it in their head. We still owe $8,000, right? We owed them 10, but now after we debited here, we only owe them 8 because we returned this. So this is literally flipping over. We bought an asset on account, we sent some back, so we flipped over the entry. We're basically undoing part of the entry. That's all that's happening there. Okay? Yeah?
So the one that's like sales returns and allowances, that's just like when a customer will return it
To us, yes. If we were on the periodic method, we might use something here called purchase returns and allowances. But since we're on the periodic method, this will be on the periodic method on the test. This will be on the perpetual method on the test. When you're doing the perpetual method, you don't use those kind of contra accounts on this purchase side. You just put it right in the inventory and accounts payable. But when we do the sale one, we will use that sales returns and allowances. But not on the purchase side. If we return something on the purchase side, just flip it over. Okay? Now, we're a good company. We pay our bills. We don't want Nike mad at us, right? And again, we're not going to ever pay within the discount period, so we don't have to worry about taking any percentage off. But we do have to pay our money. So is the cash going to be coming in or out? Out. We're paying Nike. Cash is going to go out. The rest of the payable is going to go away. Just remember, the only tricky part of this one is only pay the amount we still owe them. So I would always do a little T account and post these things to accounts payable. You can probably do it in your head, right? We only owe 8,000, so that's what we want to debit that so it goes away. We don't owe any more money, so we would debit that. Everybody got that? This is the purchase entries. Buy an asset on account. This happens to be inventory. Flip it over when we return it, and then pay off the payable. Just make sure you're only paying how much you really owe. That's all the purchase side is, those 3 entries, okay? I might ask what happens if we have to pay money to ship the inventory from Nike to our store. Okay, so the shipping cost is the shipping cost to come to our store. And that is going to have to go to inventory. Usually we pay cash for the shipping. Okay, so to our store, that's the key here. When it's going to our store, we're going to just put it to inventory. Not shipping expense, we're going to put it to inventory. Okay? Because there's this rule in accounting that any cost to get the inventory to the location in the condition to sell, so any cost to get that inventory to our store and get it ready to sell has to go into the inventory cost, not into shipping expense or anything. So if we ship it to our store and we pay the shipping, it's got to go in inventory. If we pay someone to put the shoestrings in, all the shoes, they come without shoestrings, and we pay somebody to put all the shoestrings in, their salary actually should go into inventory because it's a cost to get the shoes ready to sell. That's just a general rule, okay? So just kind of remember that. To our store is going to be going to inventory. Now, on the sales side, so move my desk over. Okay, so for the entries on the sales side, entries to sell inventory on the perpetual method. into your head when I said this? We're gonna do sale and inventory on the perpetual method. Two entries in every sale, and 2 entries at every return. Because remember, we have to record, I erased my shoe, but we have to record the sales price, the $100, and we have to record the $40 because we're gonna update cost of goods sold every time. All right? So those entries will look like the ones here for June on the bottom. This is a different company. We're gonna sell some inventory, okay? So on June 12th, we sold some inventory. And now these are our credit terms because we're selling on account, remember? You don't have to really know what that means, just make sure you know that means it's on account. We're not gonna get the cash now, we're gonna get it later, right? Now, the problem gives us 2 numbers. So it has, we sold something that cost the sales price is $12,000, and it cost us, think of, that's what we paid Nike, right? $5,000. So the problem will give you 2 numbers. That should help you remember you need 2 entries. All right? So we're gonna make this sale on account. So I already mentioned we're changing our revenue account. Revenue is still credited. So we're gonna credit sales, and it's on account because it has those terms, right? So we made a sale on account. Instead of having service revenue credited, we're gonna do sales because we're selling inventory. This is the sales price, okay? Make a sale on account. But we're on a perpetual inventory method. So this was on June 12th. So also on June 12th, we have to do the one where we record the cost of goods sold. Remember, the inventory went away. The inventory went to our customer. So we're taking the shoes off our shelves. That's why this is credited. And we're going to debit cost of goods sold. So again, think of this as inventory expense and inventory, but we don't call it inventory expense. We call it cost of goods sold, because that's what it is. It's the cost of the goods you just sold. Okay? So 2 entries, one for the sales price, accounts receivable and sales, and one for the cost of the goods. We're taking it out of inventory and moving it into the expense. Right? Everybody got that? Right, so that's when we do the sale. Now, just like we return some inventory to Nike, our customer might return some inventory to us. So we have to record a return. Okay, now, over here, when we return inventory to Nike, we just flipped it over. This is almost flipping over. The only thing is, remember, it's going to be flipping over, except we don't want to ever debit sales. Okay, so don't debit sales. So we're going to, everything else is just flipped over, but we're not going to debit sales. Instead, we're going to debit, this is on June 20, we're going to debit sales, returns, and allowances. Okay, but the rest is just flipped over. So the inventory came back, right? We got to do 2 entries at every sale and return. So the inventory came back. We've got to reduce the cost of goods sold. So everything else is just flipped over, okay? We're undoing part of the sale. So this problem said, go back over here, that on June 20, the customer returned merchandise. It cost $400. This is the cost. Remember, inventory and cost of goods sold goes with the cost. And the sales price was $1,000. Excuse me. Looks like that. Okay? So again, flip over, except don't debit sales. Now, this is a contra revenue account. So this is how we have a contra asset for accumulated depreciation. This is a contra revenue account. So on the financial statements, this is going to go on the income statement. It's going to go right below and subtracted from sales. So when we do our income statement in a minute, we're going to have sales, and then we're going to, right below that, we're going to subtract sales, returns, and allowances. All right? And there's gonna be another contra one called sales discounts, which we're not using in our entries, but we are gonna do it on our income statement. These two things are both contra revenue accounts. So on income statements, they go right below and they're subtracted to what they're contra to, which is the revenue account sales. This is then called net sales. So remember when I did that formula for gross profit, I used net sales. So that means that's already after the returns and the discounts, okay? Again, we're not gonna do the sales discounts in our entry, but you should know that that's a contra account as well. Couple things, okay? Why don't we just debit sales here? Why do you think we want to keep track of returns and allowances? That's really why we use this contra account. We want to keep track of all the returns. If you were a shoe store, why would you want to keep good track of the shoes that are being returned? Probably something wrong with them. So this is a quality control issue. So a company could just debit sales, and then their sales account would just be whatever their net sales are. But then they wouldn't have a good record of things being returned. If we keep getting back these same New Balance shoes over and over, maybe they're not missized or something, or the quality's not good. So we don't want to buy those for our store anymore. So that's why we use this contra account. We want to keep track of that as a quality control issue. All right? So that's, otherwise this is just flipped over. We're undoing part of the sale because the customers returned something. And then the last entry, we sell to good customers. So eventually our customers are gonna pay us the amount they owe us, okay? And in this problem, that happens on July 15th. So again, we're not doing this with any discount. So all we have to do here is collect the receivable. So the cash is coming from the customer, and they don't owe us any more money. So this is a chapter 2 entry, you already know it, collect the receivable. The only thing is we need to know how much it should be. How much do they still owe us at this point after the return? They owed us 12, right? Receivable, and then we reduced this receivable 1,000 when they returned it, so now they only owe us 11. All right, did everybody see that? So the big wrinkle here, I would say, is that we're on the perpetual method. So remember, 2 entries at every sale and 2 entries at the return. Okay, again, these problems on the test are going to be very similar, different numbers, right? Otherwise, they'll be the same. What was I going to say? Now, the sales price has to do with what your customer sees, right? This is the sale, this is what they pay, and this is how much they owe us, and then they're going to pay us later. So this has to do with the sales price. The cost of the goods sold goes with inventory and cost of goods sold. So the problem gives you 2 numbers. Remember, this is the sales price, and this is the cost. And I like to say, never the twain shall meet. Because students give me some really weird entries, like they put accounts receivable and inventory in the same entry, or sales and cost of goods sold in the same entry. That doesn't make sense, because these 2 are sales price accounts, and these 2 are cost accounts. They aren't used together, they're separate, right? We want to get gross profit, so we want to record the sales price and we want to record the cost, but those are 2 different things. Now, if we're going to pay shipping to our customer, let's say we do online, so we pay the money to ship to our customer. So ship from our store, I'm going to say it that way, from our store to the customer, then that can be debited to shipping expense, okay? That can be expense. That one doesn't go to inventory. Oops. Shipping expense. I think the book sometimes calls this freight out, but I don't use that one. Okay? And again, I'm not gonna, on the test, I'm not gonna ask you this entry or that entry. I know it's on the notes, but I might ask you, which one of these goes to inventory? Is it going to the store or is it going from the store? Which one has to go to inventory? Yeah, because the shipping have to go through inventory if it's going to the store or away from the store, from the store. The answer is to the store. This rule only applies when inventory is getting to the location and condition to sell it, so. Next year, when you do the accounting 230 and you're doing managerial accounting, that rule comes into play a whole bunch, because anything that Nike has to get their inventory ready to sell has to go into the inventory, including the electricity in the factory and the supervisor of the factory. So lots of costs all have to get into that inventory. All the overhead of the factory have to go in there too. So that rule really, you'll see this rule. If it's to the location to sell, it has to be, goes to the inventory. All right, that's enough of that. All right. So remember, now we could look at this company and we could say, what is the gross profit here? Okay. So the sales are $12,000. We had a $1,000 of returns and allowances. We didn't do discounts here. So our net sales are $11,000. Then we have to subtract our cost of goods sold. Now, one thing I should have mentioned, remember our cost of goods sold changed as well because we had this return. So, again, sometimes you might want to do a little T account. We had cost of goods sold of $5,000. Then we credited it for the return. So we're down to $4,600. Okay. So we're going to subtract $4,600 here. And we're going to get $6,400 as our gross profit. For this problem, right? So we sold some shoes for $11,000. After the return, cost of goods sold was $46,000. So we made $6,400, a little more than 50% gross profit margin. All right, everybody got those entries then? Can you do those on Tuesday? That's that part. All right. Well, one thing I was going to mention is, remember how some of my students were kidding me, they're going to put it on my tombstone. Expenses are debits, expenses are debits, expenses are debits. This is an exception to that. Closing entries and this return here are an exception to this. This is an expense and it's being credited, okay? So this is okay in this instance. Cost of goods sold is a special case, can be credited there. All right. So again, if you lose your mind, think about what way the inventory is going, right? We're shipping it to our customer, now they're sending it back to us, it's going to be debited, so think of it that way. Otherwise, and the return is just a flip, except don't debit sales, debit sales returns and allowances. Now, I mentioned the other thing we're going to do is a multiple step income statement. So you tell me what time it is.
1:22.
One what?
22.
1:22, so I got half hour, good, this is going to take a minute. All right, so we just have been doing our income statements as revenue and then expenses, okay? And then that'll be our net income. But really, to help the users of the financial statements better, it would be helpful if we did some subtotals. So when you study this multiple step income statement, I give you an example of what it would look like. Remember on the test, you're also going to have to do the statement of shareholders' equity in the classified balance sheet, but this is how you're going to do the multiple step income statement. I would focus on the subtotals, okay? I would focus on the subtotals. So the top of the income statement I already did, but I did that problem. This is how this multiple step income statement is going to start, okay? So we're going to do the company name, and then we're going to do income statement. You can put multiple step there if you wanted. You just need to know that's what we're always going to do in this class from now on. Income statement, and then for the month ended, let's see what this problem says here. What's for the year? For the year ended. 6/30/2014. Update my problem here. All right, so how are we going to start? Well, we're gonna start with revenue again, but now remember our revenue is our sales here. And we have to calculate this gross profit, so this is gonna be the top part. Okay, so you're gonna look for sales. Sales. Again, you have the answer key, I know, so you don't have to do it, but just so you see how I'm working this. Then you have to take the two contra ones off, and these are contra accounts, so they get subtracted right below and subtracted from. So sales returns and allowances and sales discounts are the two contra accounts. Okay, so we're going to subtract 29,200 and 5,000. And you can put brackets on here or not, I know they're subtracted, but anyway, just to remind you they're subtracted. And this is our net sales. So kind of memorize these. Oh, I said I was going to do different color for the subtotals. So net sales is our first subtotal. And remember, the word net means something's been subtracted. So when we do net income, that means the expenses have been subtracted. Here, these two contra accounts have been subtracted. So we use this word net. Sales net of the returns and allowances, right? Of the two contra accounts. So that's going to be, we do a subtotal, 785,800, right? Sales minus sales returns and allowances minus sales discounts is net sales. Then, well, the next subtotal is gross profit. So we have to subtract cost of goods sold. And that'll give us our gross profit. So again, the main thing we're changing here, we still have revenue minus expenses, but now we're a merchandising company, and we're going to do a lot of subtotals. That's why I'm putting these in blue. So you're going to look on the list. Cost of goods sold on the list is 513,400. So gross profit is 272,400. Okay, so this company doesn't have as good as gross profit as that one, but you know, it depends on what they're selling. You're not going to have a huge markup on cereal, as you might on shoes or jewelry or something, right? So maybe this is still a good gross profit. Now, before on our income statement, we just took all the expenses then, right? Revenue minus all the expenses. We're still going to do that, but we have some very special expenses we're going to pull out to the side. We're going to pull out, they're going to go down at the bottom. So when you do this, look for all the expenses, except remember, interest expense goes down at the bottom, and income tax expense goes at the bottom. So I'm doing this because that's how I do that when I'm doing this problem. I look down the list and I look for all the expenses. And when I get to interest expense and income tax expense, I do this. I make a little arrow to remind me they come later. We also did revenue minus expenses, but now we're going to find out that if we have some other kinds of income, like interest income, then this is going to go down at the bottom either. If we have income from things that aren't from selling the shoes, we're going to put that as the bottom as well, okay? But otherwise, other than these, the expenses come next, just like we did before. And we're going to call these operating expenses, because this is from operating the shoe store, okay? Depending on what kind of store you have, these expenses are from just operating the store. So it doesn't include interest, which is a financing thing. It doesn't include income tax expense. If we actually sold some extra shelving that we have, that would go down here too, because that's not what we do. We don't sell shelving, we sell this. Yeah?
I was about to ask why they go at the bottom.
Yeah. What's going to happen is we're going to have a subtotal here called operating income. Income from operations or operating income. And that's a really important number because that's this is what we make from just selling the shoes. And if we were going to project this into the future, which is what you want to do when you're looking to invest in the stock market, how much money is this company going to make in the future, that operating income is a good one to do, okay? Because Interest, income tax. Interest is based on the finance department. Are we borrowing more money? Are we investing more? What are we doing? These numbers come from, this isn't part of running the shoe store, this is our finance decisions. And this income tax expense depends on the government and things. So we want to pull those out. And if we sold some extra shelving, we might do that this year, but maybe we won't do that in 2015. So we don't want to project our income into the future, including the sale of that shelving. We might never do that again. So we want to have this subtotal of just from running the shoe store. That's really what we're trying to get to. So we're going to take all these operating expenses. I'm going to do this really fast. Again, you're going to look down, and I don't know why my depreciation expense went to 2 lines, but it did. So again, insurance expense starts with an I, but it's not special. Depreciation expense isn't special. Utilities expense, advertising expense. And we're just going to list them all. I usually do the numbers in a separate column here, not because it has anything to do with debits and credits, but just because then I'm going to do a subtotal of these, and I like to make it obvious that what's included in the subtotal is just these expenses. So that's why I do it that way. I don't expect you to put a box around there, I'm just showing you that I'm using different columns. Write all these other expenses down. So this is still the income statement, it's still revenue minus expenses, but now we have lots of subtotals. So we're going to put total operating expenses, and that ends up being, and accountants like to do the subtotal and then put it down over here, just so it's ready to go to subtract from there, because that's going to be our next step. So these expenses total 1,778. These are our total operating expenses. Again, that's just from operating the shoe store. These are special, they aren't in there. Then we're going to subtract total operating expenses from gross profit. And this comes out to be income from operations. That ends up being $94,600. Okay. Now, sometimes you can also call this operating income. Just flip the two words around. Either one is fine. But remember, the idea is we want this subtotal, which is the income from just running the shoe store, right? This is the income from just selling the shoes. And this is the income from just running the shoe store. It doesn't have all this other corporate stuff in there. Or things that are only going to happen one time. So if we would have a gain on sale, I don't think I put this one on the final, but or a loss on sale, they would go down here at the bottom too. Because again, these are, maybe we had some gain on some sale of investments. That doesn't have anything to do with the shoe store. Or a loss on some equipment that we sold. That doesn't have anything to do with the shoe store. And we don't want to project that to the future. This is the one we would use to project our income into the future. So that's why we like the subtotal. This is the one that students, I should have done that in blue. Should have done these two in blue. These are the ones, this is the one that students don't remember. Income from operations or operating income. So I'll just be walking around the final exam and they'll be doing their multiple step income statement and they'll get down to that part right there and they'll just sit there and be like, oh my God, I don't remember what this one's called. So put it in your head somehow. Income from operations or operating income. Remember, it's from operating the shoe store, and these are operating expenses. So this is after those operating expenses, okay? Everybody got that? All right, now, this just keeps going down below there. Obviously, I don't have room, I don't leave room, but what I'm doing here is would be keep going. All right, so once you get to there, after you get to income from operations, you got to subtract this other stuff. Okay, so I'm repeating this. It doesn't get twice. I'm just showing you where I'm leaving off from. Okay. All right. Now, we have to do this other stuff. I'll just tell you, income tax is the very last one. So this next section is all this other stuff, okay? And we just call that other income and expenses. So those miscellaneous things that I told you to pull out, other than income tax, are gonna go here. So both of the interests go here. I'm gonna put interest income here. And interest expense, both go in this section, okay? Again, if there would be any gain or loss on something, then that would go in here too. I don't think I put that on the test though, but if there was, it would go in here too. Now, the thing that kind of messes students up again is, remember, we're used to having revenue minus expenses, but now we have revenue minus expenses, and now some income and expenses all mixed together. So just make sure you get the right sign here. All right, this 7,000 should be added in, and this expense should be subtracted, so make sure you get the right sign on those. Everybody got that? Sometimes the book does a subtotal here. I don't usually do that, but the book might. It's fine if you do. I'm not going to. All right? I'm not going to subtotal the 7 and the 12. I'm not going to put -5. Sometimes the book does that. But I'm just going to add this and subtract this from that number. Okay? Now, we need a name for this. 94,600 plus 7 minus 12, we need a name for that. We don't really have a good name for this income. Oh, I know. We'll name it based on what's coming next. We'll name it based on what's coming next. This is the only expense we still need. So we're going to call this one 89.6, which is again 94.6 plus 7 minus 12. We're going to call this income before income tax. So this one is named by what comes next. Income before income tax. And again, I said I was going to do blue, and then I didn't do blue. This one should be blue. This is a subtotal. Right? Then, obviously, if this is income before income tax, we're going to subtract income tax expense. This is a corporation. We've been corporations all year. Corporations pay their own income tax. And now we have net income. So this is still the income statement. We're just doing lots of subtotals here. Okay? So, again, memorize this, but make sure you think about what it means and do the right sign. I can't tell you how many times people just say sales minus sales returns and allowances, sales discounts equals net sales, cost of goods sold, gross profit. And then they add gross profit, they add cost of goods sold in here. That doesn't make sense. Remember, you're trying to decide this is the sales price and this is the cost. You're trying to figure out how much you make on the sale of the shoes. So memorize it, but also think about what it means, right? So on your answer key there, I put lines at the subtotals. I put equals at the subtotals, and make sure you have the right signs here. So sales minus sales returns and allowances minus sales discounts is net sales, minus cost of goods sold is gross profit. Then you're going to do all the operating expenses. Remember, interest expense, interest income, income tax expense, they get pulled out. Otherwise, the rest of the expenses go here other than cost of goods sold. Total operating expenses, it's just these. Then income from operations. I'm going to make that blue. So we're going to have total operating expenses. And we're going to have income from operations. So those are our subtotals. Income from operations. And this is part of the gap. They'd rather have you do multiple step than single step, but this is really helpful for the users. Some companies don't do a multiple step, and then you have to calculate this gross profit by yourself. It always irritates me. This is an important number for this company. And this is the number you would want to project to the future, so those are important numbers. Then, after income from operations, we have this other income and expense section. Remember, that's the interest. Both of the interests go in there. If there was a gain and loss, it would go in there, but I don't think I have that on the final. But remember, get the signs right? Add in the income, subtract the expense, and then this is income before income tax. And then, income tax expense, then we still end up with net income is still the last number. Woo, that was a workout there. All right? Any questions on that? So on the final, when it says to do a multiple step income statement, that's what I expect those subtotals in there. All right, everybody got that? Any questions there? All right, so the new things here are the stars, are the buy and resale inventory entries in the multiple step income statement. Okay? Any other quick questions before about the task, or what else you still have to do, or anything?
You said the test starts at 12 on Tuesday?
It starts at 12. If I start at the hour, I technically can give you 2 hours to do it. If we start at the regular time, I'd have to be out at the regular time. But if we start at noon, that's how they set up exams. If you start at the top of the hour, you get 2 hours, so that's what we're gonna do. I don't think everybody, I mean, the first class had to do it during class for an hour and 20 minutes, and there were 2 people still working, but I think they were just reviewing. I don't think their balance sheet balanced, and they couldn't figure out why, but otherwise everybody finished in time, so if we start at noon, you'll probably be out before 2 hours. Might as well give you 2 hours if I can. So, just a couple things. Again, review your exams here for these 2, the journal entries and the exams, and for the circle things, right? You're going to do this multiple step income statement. We really haven't changed this statement of shareholders' equity, but it's not going to be a new company. So what does that mean when you do your statement of shareholders' equity?
Is there already common stock in the
Yeah, and the common stock number, let's say that on the list of the adjusted trial balance information, let's say it was $40,000 for common stock. Is this the ending number or the beginning number? This is the ending number. CSEN. CSEN, that's how I like to remember it. Because, let's say that the problem says $5,000 of common stock was issued during the period. Well, if 5,000 of common stock was issued during the period, this entry was already done. It's already posted in the ledger. It's already been in the trial balance. It's already in there. So when we do that, these numbers come from the adjusted trial balance. So if we issued stock during the period, this has already been posted. So what you're going to do then is you're going to say this is the ending number. Then you're going to put stock issued, 5,000, because that's what the problem said. And then the beginning common stock must have been 35,000. So you're going to work backwards. This is the number on the list. This is the CSEN, ending number. But we only update the retained earnings number through closing entries, and closing entries are done after the financial statements are prepared. So it hasn't been updated yet. So the number on the retained earnings on the adjusted trial balance is where I'm saying the numbers are coming from. Let's say it's 8,000. That's the beginning, because we haven't done the adjusting entries. So that's why I always say CSEN and rebid. This one is the ending number. This one is the beginning number. Then what do we add in here? Net income. That hasn't changed. It's a lot longer to get to net income, but still net income. We would add that in. And what would we subtract? Dividend. And that's on the list, so whatever the number is, we'll make up a number, I don't know. Right? And that's the ending retained earnings. And then this goes to the balance sheet, right? Ending retained earnings. Whatever this is. I'm just making these numbers up here, but these 2 are the 2 that go on the balance sheet, the ending numbers for the shareholders' equity section of the balance sheet, okay? And you're going to do a classified balance sheet. So I mentioned earlier, what are the 3 current assets, the first 3?
Cash, accounts receivable,
Okay, and then all the other assets you know except equipment are going to be listed there with X. I don't care the order of those. That's your total current assets. Then you're gonna do under long-term equipment. What happens right under equipment? What goes under equipment? Accumulated depreciation. That's a contra asset account. It goes right below and subtracted from what it's contra to, and it's contra to equipment. So the only thing in the long-term asset section will be equipment, and then right below that is accumulated depreciation. Then you'll have your total assets. Then, what is the only long-term liability we know? We're gonna have notes payable. Is notes payable current or is notes payable long-term? It's actually both. Because the payments that are due in the next 12 months have to be current liability, and the payments due later have to be long-term. So, how this works is on the list, it'll say notes payable, $60,000 or whatever the number is. And then in the verbiage to the problem, it'll say something like this: 10,000 of the notes payable is due within 12 months. That's not another 10,000. They're telling you how much of this to put in the current. So under the current liabilities, you're gonna put notes payable, 10,000. And under the long-term liabilities, you're gonna put notes payable, and you're gonna put the difference, 50,000. So this is being told to you, so, oops, not that. This is being told to you so you know how to split the notes payable between those two. Everything else you know is current. This is the only long-term one you know, but you need to put it in both sections. Got that? Those are the only wrinkles. So when I give you the verbiage to the problem, I have to tell you the company name, the period that it's covering, okay? I have to tell you how much of the common stock was issued during the period so you can make this split, because the number I give you is going to be the ending, so I got to tell you how to split that. And the other thing I have to tell you is how to split the notes payable, so that'll be all in the verbiage in the problem. All right? You guys pretty comfortable? You think you can do the financial statements? Yeah? Okay, because that's really the key thing to this whole class is the financial statements. And I don't think anybody here is in that position, but if you're on the bubble between passing and not passing, on the final exam, that's what I do. I pull out the final exam, and if they did a good job on the financial statement problem, I probably give them the bump. If they didn't, then I don't give them the bump, okay? Because this is the main thing of the class. You need to know what financial statements look like. The sad part to me is sometimes students don't give me a financial statements, they give me a trial balance. So I'm giving you numbers from an adjusted trial balance. They're not going to be debit and credit because that would make it too easy. They're just going to be in one list, probably in alphabetical order, or just in a random order. But what some students do is they just give me a trial balance. They put they put all the accounts and then they put some debits and credits. But that's not financial statements. I have to take off a lot of points on that. So make sure you're giving me financial statements, because that's kind of sad for me when I have to take off from that, so you don't understand. All right, anything else? Nobody's graduating, are they? Not yet. Guess not. You need to take 230 still, but all right, it's exciting. Almost there. You can take off. Thank you.